You know, in my 4 decades of managing money through every presidential election since 1980, I've learned that successful investing during political cycles isn't about predicting winners, it's about positioning portfolios for economic realities that persist regardless of which party controls Washington. At JPMorgan Chase, managing over $3.7 trillion in assets, we've developed institutional strategies for navigating election uncertainty that focus on fundamental economic trends rather than political speculation. Elections create short-term volatility, but long-term wealth is built by owning assets that benefit from structural forces transcending political cycles. Today, I want to share 5 specific asset classes you should consider purchasing before the election, not because of partisan beliefs, but because these investments position you for economic realities any administration will face: infrastructure needs, demographic trends, energy security, fiscal pressures, and global competition. The first asset you should buy before the election is Treasury inflation-protected securities, or TIPS. Election cycles invariably involve spending promises from both parties that create inflationary pressures regardless of which candidates win. Campaign promises for infrastructure investment, tax cuts, spending programs, or defense increases all point toward fiscal policies that tend to be inflationary over time. At JPMorgan, our analysis shows government spending typically increases regardless of party control, as politicians seek to deliver on campaign promises while maintaining economic growth. This spending pattern, combined with Federal Reserve policies supporting economic stability during transitions, creates inflationary environments that erode purchasing power of traditional bonds and cash. TIPS provide direct protection by adjusting principal value based on consumer price index changes. Unlike traditional bonds that lose real value during inflationary periods, TIPS maintain purchasing power while providing steady income that adjusts upward with rising prices. Historical analysis shows TIPS outperform traditional Treasury bonds during post-election periods when fiscal policies become more expansionary. During the 2016-2020 period, TIPS generated superior real returns compared to conventional bonds as fiscal stimulus and tax policies created inflationary pressures that benefited inflation-protected securities. The current political environment suggests fiscal expansion is likely regardless of election outcomes, as both parties support different forms of government spending that would increase demand and potentially drive inflation. Infrastructure investment, defense spending, social programs, and tax policy changes all have inflationary implications that make TIPS attractive as portfolio protection. TIPS also provide stability during election volatility, as government-backed securities tend to outperform during periods of political uncertainty when investors seek safe assets with predictable returns. The inflation protection feature becomes particularly valuable when fiscal policies are uncertain and monetary policy responses are unpredictable. At JPMorgan, we typically recommend TIPS allocations of 10% to 20% of bond portfolios during election years, purchased through Treasury auctions or diversified funds, providing broad exposure to inflation-protected securities. The tax advantages of TIPS are particularly relevant during election periods when tax policy changes may affect other investments, with TIPS held in tax-advantaged accounts, avoiding annual taxation of inflation adjustments. The second asset you should buy before the election is energy infrastructure and utilities. Energy security represents one of the few truly bipartisan priorities in American politics, making energy infrastructure investments relatively insulated from electoral outcomes while positioned for long-term growth, regardless of policy directions. Both major parties support energy independence, though they prefer different energy sources and technologies. This creates investment opportunities in infrastructure serving multiple energy sectors, including traditional fossil fuels, renewable energy, and emerging technologies like nuclear and hydrogen. At JPMorgan, our energy analysts have identified infrastructure assets that benefit from energy policies across the political spectrum. Transmission lines carrying both renewable and conventional power, pipeline systems transporting various energy sources, and utility companies distributing electricity regardless of generation methods. The mathematical reality of America's energy consumption growth makes infrastructure investment necessary regardless of political preferences. Data centers supporting artificial intelligence are driving unprecedented electricity demand growth, requiring massive infrastructure investment that will occur regardless of election outcomes. A single large AI data center can consume as much electricity as a small city creating demand that must be met through new generation and transmission infrastructure. Energy infrastructure assets typically provide stable dividend income that often increases with inflation, making them valuable during periods of fiscal expansion and monetary uncertainty. Utilities and pipeline companies operate under regulatory frameworks that provide predictable cash flows and inflation-adjusted returns that protect purchasing power during economic transitions. The geographic diversification of energy infrastructure provides protection against regional political changes while capturing growth opportunities across different energy markets. Interstate pipeline systems, multi-state utility companies, and national transmission networks benefit from energy demand growth regardless of local political preferences. Master limited partnerships, MLPs, and energy infrastructure offer tax advantages that become particularly valuable during election periods when tax policy uncertainty affects other investment categories. MLPs distribute income that receives favorable tax treatment while providing exposure to energy infrastructure growth. At JPMorgan, we recommend energy infrastructure exposure through diversified funds that hold pipeline companies, utilities, and transmission operators rather than individual securities, providing broad exposure to energy infrastructure growth while managing company-specific risks. The third asset you should buy before the election is defense and aerospace securities. Geopolitical realities ensure defense spending remains a priority regardless of domestic political outcomes, making defense and aerospace investments relatively stable during election cycles while positioned for long-term growth driven by global security challenges. Both major parties support strong national defense, though they may emphasize different spending priorities. This bipartisan support creates stable demand for aerospace products, defense technologies, and military equipment that transcends electoral cycles. At JPMorgan, our defense sector analysis shows that geopolitical tensions with China, Russia, and other strategic competitors require sustained defense investment regardless of domestic political leadership. Military modernization, cybersecurity capabilities, and advanced weapons systems represent long-term themes that persist across political transitions. The global nature of defense contracts provides revenue stability while reducing dependence on domestic political decisions. Major aerospace and defense companies derive substantial revenue from allied nations and international customers, diversifying political risk across multiple governments. NATO allies are increasing defense spending targets, creating international demand that supplements domestic purchases. Defense and aerospace companies typically maintain strong balance sheets and generate substantial cash flows, supporting dividend payments, providing income during political uncertainty. Government contract structures provide predictable revenue streams that support consistent shareholder returns even during budget uncertainty. Technology investments by defense contractors position these companies for growth in emerging areas like artificial intelligence, cybersecurity, and space technologies that have applications beyond traditional military uses. Defense research and development often creates commercial technologies that generate additional revenue streams, from GPS systems to internet technologies. The space economy represents a growth opportunity within defense that benefits from both government and commercial demand. Satellite communications, space exploration, and defense applications create multiple revenue sources that reduce dependence on traditional defense spending patterns. Commercial space ventures are creating new markets that complement government space programs. At JPMorgan, we recommend defense and aerospace exposure through diversified funds that hold major contractors and technology companies rather than individual securities, providing broad exposure to defense spending while managing company-specific risks related to contract awards and program changes. The fourth asset you should buy before the election is healthcare and biotechnology. Demographic trends driving healthcare demand represent unstoppable economic forces that create investment opportunities regardless of political outcomes. America's aging population requires healthcare services and pharmaceutical products that must be provided regardless of electoral results. Both political parties acknowledge the necessity of healthcare innovation and access, though they prefer different approaches to financing and delivery. This bipartisan recognition creates stable demand for medical technologies, pharmaceutical products, and healthcare services that transcend political cycles. At JPMorgan, our healthcare analysts project that aging demographics will drive healthcare spending growth for decades, regardless of policy changes, as medical needs increase with age and new technologies extend lifespans while creating additional treatment options. The baby boomer generation represents the largest demographic cohort in American history entering their highest healthcare consumption years. The global nature of healthcare and pharmaceutical markets provides revenue diversification that reduces dependence on domestic political decisions. Major healthcare companies derive substantial revenue from international markets, protecting against domestic policy uncertainty. Emerging markets with growing middle classes represent significant growth opportunities for healthcare companies. Biotechnology innovation represents growth opportunities based on scientific advancement rather than political decisions. Drug development timelines span multiple electoral cycles, providing investment opportunities based on scientific progress rather than policy changes. Gene therapy, personalized medicine, and artificial intelligence applications in healthcare represent long-term growth themes independent of political leadership. Healthcare REITs provide exposure to healthcare growth through ownership of medical facilities and senior housing that generates stable rental income regardless of policy changes. The aging population requires specialized facilities, including senior living communities, medical office buildings, and specialty care centers that provide predictable cash flows. Medical device companies benefit from demographic trends and technological advancement that drive demand growth regardless of healthcare policy directions. Surgical equipment, diagnostic technologies, and treatment devices serve medical needs that persist across political transitions. Minimally invasive procedures and robotic surgery represent growth areas driven by technology rather than politics. At JPMorgan, we recommend healthcare exposure through diversified funds that hold pharmaceutical companies, biotechnology firms, medical device manufacturers, and healthcare service providers, providing broad exposure to healthcare growth while managing regulatory and development risks. The fifth asset you should buy before the election is international diversification through developed market funds. Election outcomes affect domestic markets more significantly than international markets, making global diversification valuable for reducing portfolio risk during political transitions while maintaining growth opportunities in economies less affected by American political changes. International diversification provides currency protection against potential dollar weakness that may result from fiscal policies regardless of electoral outcomes. Exposure to foreign currencies through international investments can protect purchasing power if dollar-denominating policies affect exchange rates. At JPMorgan, our global strategy team emphasizes that economic growth opportunities exist worldwide, regardless of American political outcomes, making international exposure valuable for capturing global growth while reducing dependence on domestic political and economic cycles. European markets often trade at discounts to American markets during election periods, providing value opportunities for patient investors. Asian markets, particularly Japan and developed Asian economies, provide exposure to technological innovation and demographic trends that operate independently of American political cycles. International bond funds provide exposure to foreign government securities and corporate bonds that may outperform during periods of American political uncertainty. At JPMorgan, we recommend international exposure through diversified funds that hold developed market securities rather than individual foreign stocks. The correlation benefits of international diversification become particularly valuable during election periods when domestic political uncertainty creates volatility that affects American markets more than foreign markets. Portfolio allocation strategy for implementing these election year investments should reflect individual risk tolerance while providing comprehensive protection. At JPMorgan, we recommend beginning purchases during the summer before elections when political uncertainty is increasing but hasn't reached peak levels. Typical recommendations for election year positioning include 15% to 20% tips within bond allocations, 10% to 15% energy infrastructure, 5% to 10% defense and aerospace exposure, 15% to 20% healthcare allocation, and 20% to 30% international diversification. These allocations should complement existing diversification strategies, maintaining broad market index fund exposure while adding specific election cycle protection. Rebalancing disciplines become particularly important during election periods when volatility creates opportunities to capture gains from protective positions. Common mistakes during election cycles include making decisions based on political preferences rather than economic analysis, emotional trading based on election fears, market timing attempts based on election predictions, and concentration risk from large election-related bets. At JPMorgan, successful election cycle investing focuses on quality assets that benefit from long-term economic trends rather than short-term political speculation, emphasizing patience and discipline over reactivity and timing attempts. These 5 asset classes work together to create a coherent election year strategy, providing both protection and growth potential. The defensive characteristics of TIPS and international diversification provide portfolio stability, while energy infrastructure, healthcare, and defense position portfolios for long-term economic trends persisting regardless of political outcomes. The income generation from these asset classes provides cash flow during volatile periods, reducing dependence on capital appreciation while maintaining purchasing power protection. The correlation benefits provide diversification that reduces overall portfolio volatility while maintaining exposure to different economic factors. Markets are forward-looking mechanisms that incorporate available information about potential policy changes long before elections occur, making it difficult for individual investors to profit from election-related trading strategies that institutional investors have already implemented. The economic challenges facing America, infrastructure deficits, demographic transitions, energy security, fiscal constraints, and global competition require solutions regardless of political leadership, creating investment opportunities in companies and sectors that address these fundamental needs. At JPMorgan, our most successful clients during election cycles focus on quality companies with strong competitive positions and sustainable business models, rather than attempting to profit from short-term political speculation. The mathematical power of compound returns over multiple election cycles far exceeds potential gains from successful election timing. These 5 asset classes, TIPS, energy infrastructure, defense and aerospace, healthcare, and international diversification, provide a framework for election year investing that emphasizes economic fundamentals over political speculation while providing protection against various electoral scenarios. Your investment success during election cycles will depend more on discipline, diversification, and focus on economic fundamentals than on accuracy in predicting electoral outcomes or short-term policy impacts. Successful investing transcends political cycles by focusing on companies and assets that create value regardless of political leadership.